Hi folks, this is Sean Hyman from Chart of the Day, and I just want to say I hope you had a great Thanksgiving holiday. I know we've got a lot to be thankful for just by the fact that we are living, breathing, we're able to function. We've got a lot to be thankful for our friends, our family, things of that sort, our provisions. So always remember to give thanks during these times. It's a good practice to teach your kids and to show your kids as well. So I want to talk to you today about how to gauge the volatility of a pair. And you can do this simply by using what's called the ATR indicator, average true range indicator, average true range, ATR. And I use a 14 period, which is pretty standard. It's usually the default setting, and I usually look to do these on the daily chart. So I'll do a daily chart going back about 1 year. This happens to be on the Aussie New Zealand pair, Aussie Kiwi, and this will tell us how many pips on average this pair ranges in a day. So on an average day, this pair will range about 102 pips a day. So let's compare that to something that could be a higher volatility pair. For instance, we've got 204 pips a day here on the ATR on pound yen. And so, of course, pound yen has dropped off a lot here lately with this consolidation. We're going to have a breakout here pretty soon, and that's going to tick that back up. So if you take, an average even of what it's been more recently, you could say anywhere from 204 to 250. So that's literally double to over double the volatility of Aussie Kiwi. So what does that tell us? When we are trading Aussie Kiwi, and let's say we've got on 2 lots, we can't just be a 2-lot trader on any pair. Because if we go to pound yen and its volatility, it's moving 204 to 250 pips a day, those 2 lots are going to eat us alive, and our stops are going to be very much likely to get hit if we have stops all that close at all, things of that sort. So the way to reduce volatility exposure to your account and to normalize and to levelize that volatility to make the volatility to your account in pound yen closer to what you would have with Aussie Kiwi is you can still run your 2 lots of Aussie Kiwi, but drop it down to 1 lot traded of pound yen. And in taking and normalizing your volatilities, so when something is, say, twice as volatile as the last pair you traded, taking your lot size down by half reduces the volatility to your actual account. And that's where the volatility matters. It's not so much the volatility on your chart, it's the volatility that's happening to your account. That's what concerns us. And so remember, higher volatility pairs use a lower number of lots. Low volatility pairs, now there's still nothing wrong with low volatility pairs with using a low number of lots, especially if you're newer. But if there's a time where you are using more lots, it usually needs to be on lower volatility pairs. I tend to trade and risk about 5% of my account between my entry and my stop, and that's taking into account my number of lots that I use. I tend to trade about 1 lot per $5,000 or so in a mini account. In my micro account, because I've got a mini and micro, that would be about $500 per micro lot. And that would risk about 5% of my account from where I put my stops. So you want to keep these things in mind, but the thing to take away from this is to gauge volatility of your pairs. All pairs are not created equal. Some are your slower drivers, and some are your Corvettes and Lamborghinis, and you need to know which are which. You need to know it, and you can know it by their ATR number. That way you don't have to be already familiar with a pair ahead of time, because a lot of people are coming into this market and they're new and they're not going to know the attributes of which ones are the fast moving pairs and which ones are not. The ATR will be your friend and your guide in those times. When you see high ATR readings, take the lot size down. Low ATR readings, if you're going to use higher lots, you can do it then. Also, when you see, like if you see the ATR and it starts jacking up and starts sloping way up, the higher that volatility goes, you know, in future trades you want to ratchet your number of lots down to lessen your risk and volatility exposure to your account. Thanks so much for watching.